que j'effectue la lecture des dossiers en anglais ou en français.
En anglais.
Each team has 20 minutes to present its case to the judges. I will show you a board for the 10, 5, last 2 minutes, and the last 30 seconds of presentation. During the last 10 seconds of the speech, I will indicate by means of my 2 hands the number of remaining seconds. A team not having ended its presentation after 20 minutes will be stopped to move on to the further questions. The further question of a maximal duration of 5 minutes is assigned to the jury at the end of the presentation. I would like to remind the jury that it's not mandatory to ask at least one question during this period. I will invite the judges to introduce themselves and then the team can begin.
Okay, so my name is Pierre Leblanc. I'm a tax manager here for an accounting firm in town, Boudreau Albert Savoie. I'm a former student of the University of Moncton. I did participate in the game, so I know what you guys are going through, so I wish you guys a good presentation.
Hi, my name is Pauline Gautour. I'm a senior tax manager for EY and Dieppe here, so I wish you a good presentation.
Good afternoon, everyone. My name is Sabrina Lapierre. I am a senior tax analyst with Ernst & Young here in Dieppe. I've been in your shoes before. I was involved with the Commerce Games, and it's a pleasure for me to be on the other side and listen to your presentation today, and I wish you good luck.
Thank you. So you can begin. Okay, so hello. I would like to thank you very much for taking the time to meet with us tonight. And my name is Mathieu Genot. These are my colleagues, Sabrina Larry and Miriam Aziz. And so we've looked at the material you've provided us and the points you've brought to our attention, and we'd love to take this time right now to discuss it with you. So first of all, Sabrina is going to talk about corporate tax. Miriam is going to end with the sale of the Aqua Inc., the offer that you've received recently, and that is very interesting. Then Miriam is going to touch on your tax liability for this coming year. Then she's going to talk about some income splitting opportunities for you and your husband. Also the shareholder loan that we've noticed on your balance sheet, and there's a couple of things we need to make sure to be sure that everything is on point. Then I will come in and talk to you about TFSA and RESP's opportunities that we've noticed that you didn't talk to us about, so maybe you forgot about these. Then there's childcare expenses. And then finally, the family trust. There's a couple of concerns that we'd like to clear up with you. So now let's dive into the first subject, and I'll give the floor to Sabrina. Thank you.
Thank you. So I'm going to start with the corporate tax issues. The first order of business is the sale of Aqua Inc., the offer that was received to you by Fishnets. So the current situation is that there is a buyer who's interested in purchasing the goodwill of your company, mostly for your client base, but you already have you have an existing loyal client base. You have a lot of value in your facilities in Quebec, and you want to basically retire in about 20 years. So to begin with the sale of the shares, from the buyer's perspective, they will inherit the fiscal and legal liabilities of your company, and that comes with the operations and all the work product that you have created over the past 15 years. Another point to bring up is there's going to be an acquisition of control if it's a sale of shares. This means there'll be a deemed fiscal year end, and also that the acquirers can use your capital losses, but this doesn't really benefit Fishnets because you don't have any non-capital loss carry forwards. And obviously the Fishnets Fishnets does not prefer to purchase the shares of your business, as they prefer to purchase the assets. On your perspective, by selling your assets, you can you can use your capital gains exemption to minimize your tax burden. You will relinquish your rights for your fiscal and legal liabilities to the company, and it's a relatively simple transaction in comparison to the purchase of assets. So on a qualitative level, it's better for you to sell your shares of your business. On a quantitative level, the buyer's purchase price will be $2.4 million for the purchase of your shares, and the net proceeds to you are about $2 million after paying a total tax liability of about $400,000. For the sale of shares, there was also a question that you brought up. So what should what should I do with the assets that Fishnet does not want, assuming that I sell the shares? So basically, to answer that question for you, because fishnets will acquire the business and all its fiscal and legal liabilities, they also acquire the rights and obligations to your assets. Therefore, there's nothing you can do about the ownership of those assets once you sell the shares of your business. Another interesting topic to bring up about the sale of shares is that you have to purify your business in order to meet the eligibility to use your capital gains exemption, which will actually save you a lot of money in taxes, and that's what makes this transaction beneficial for you. So the 2-year holding period, yes, this is met because you've had the company for 15 years. There's a 50% test based on the fair market value of the assets being used for primarily business income, earning active business income, 24 months prior to the sale, and we assume that this was met because you're in the manufacturing business of the aquariums, and you also render services that are aftermarket once the aquariums are sold. And the 90% test, which is immediate before the sale. You basically don't meet this requirements. You only meet 70%. You only meet the 70% test. Therefore, you must purify the business in order to benefit from the capital gains exemption. So in order to do this, we recommend that you sell your accounts receivables to a company that specializes in collecting receivables and use the cash and pay off your current liabilities and your long-term liabilities in order to purify your business and meet the 90% test right before the sale of your business in order to lower your tax burden. So on the qualitative side of the sale of the assets now, the buyer will not inherit the rights to your business. They'll just inherit the rights to those physical assets that you sold to them. And they can benefit because they can just pick and choose which assets they would like rather than buying the whole lot of assets. And this is in line with Fishnet's goals of actually just purchasing your assets, as we previously mentioned. But on your side, you'll be subject to a deemed dividend. We know that you have a GRIP balance. That means that you'll benefit from the lower rate of tax payable in that sense, but only for a portion of the sale. You will retain the legal and fiscal rights to Aqua Inc., and it's a more complicated transaction in comparison to the sale of shares. So the consensus on this is that on a qualitative level, it's better for Fishnets to purchase the assets of your business. So there's a conflict between your goals here. On a quantitative level, Fishnet's purchase price will be about $2.2 million because they're not acquiring the major capital assets, they're acquiring the goodwill and other assets such as the AR and the cash and the inventory. And on your perspective, your deemed taxable dividend will be $1.7 million after your CDA balance has reduced your deemed dividend. And your total tax payable will be about $800,000. And the net proceeds to you will be $1.4 million. And another point to consider on this transaction is that a Section 85 rollover can be used to get the assets out of the business that Fishnets does not wish to purchase. So the non-depreciable assets should be transferred at the ACV, while the depreciable assets should be transferred at their UCC. Although you should definitely avoid taking non-share consideration in order to not trigger dividend stripping. And then also on that same respect, the equipment and the vehicles could not be transferred through this transaction based on the terminal loss, and that's prohibited by the ITA. So our major recommendation, after considering the fact that you expressed to us that you want the least tax burden in the sale of your business and that you wish to retire in about 20 years, is the fact that you should sell the shares of your business because it does have a minimal tax burden for you and increase net proceeds to you after tax. And we also took into consideration the fact that Fishnets wishes to purchase this business right away, but you only want to retire in 20 years, so there is time to find other buyers to give you the value of the company that you've built over the past 15 years. And just some financing considerations for this option are that you can use the capital gains deferral. Basically what the capital gains deferral means is that if you reinvest the proceeds of disposition that you received from the sale of your business within the 120 days, and you hold the business for 6 months, and the business meets the 90% test that we discussed before, you can defer the capital gains up to the proceeds of dispositions reinvested. And the second option is the capital gains reserve. Basically, this is saying that if you get paid the proceeds of disposition, basically the purchase price of your business over 5 years, you can only include it in your business. You can include the income over 5 years in your tax return, and this will save you money based on time value of money and the marginal tax brackets that you will benefit from. So our ultimate recommendation for the financing options, if you do pursue the sale with Fishnets, is to use option 1, the capital gains deferral, as you expressed to us that you do wish to pursue investing in other businesses after you sell the shares of Aqua. So now Mariam will talk to you about the estimated tax payable.
Thank you, Sad. So it was brought to our attention that you wanted an estimate of your corporate taxes payable. All right. So we'll begin with our objective. So our objective is to calculate our corporate taxes payable, and we start with our accounting income. There are a number of adjustments that need to be made, and we'll run through each adjustment and essentially walk you through our logic as to why that adjustment is being made. Therefore, that in the future you will understand how these adjustments are essentially working with you or against you. So your beginning net income balance is $319,000. And we'll begin with the issue of meals and entertainment. Now, meals and entertainment for accounting purposes is fully deductible. However, for tax purposes, it's only 50% deductible, unfortunately. So, that adjustment nets out to $43,500, which we have to add back to your accounting net income. We go on and tackle your conventions. Now, Paula, you mentioned to us that you attended 1 convention in the year. That's fantastic. You're actually allowed to attend 2 conventions. Go ahead, they're fully deductible. Unfortunately, Stephen's conventions, they're not deductible. He's your husband, and he's not an employee or a shareholder. Therefore, we assume that Stephen's convention, and the deduction that you had made was roughly $44,000, so that's an assumption, and we added that back. Of course, we don't know the exact amount, and once we do a little bit of more research, we can find that out and give you an exact amount. Following that, we noted that in advertisements and promotions, you had some donations that you've made. Now, the donations that you've made, the $10,000 that you made to the registered charity, is deductible. However, it's just a classification issue, so not necessarily in terms of when you're calculating the taxable net income, but more when it's a Division C deduction. So net impact would be nothing. You would still be allowed to donate the $10,000 because it's less than 75% of your taxable net income for tax purposes. However, it has to be reclassified in that sense. And the donation that you made essentially to JDC, we are taking that as an advertising expense and treating it as such. However, because JDC is not a registered charity, you would not be able to deduct it as a donation. Great. Now let's go on to your insurance. So we noted that you have an annual expense of about $15,000 for life insurance that you took out. Now the life insurance proceeds that you took out, these $15,000 is deductible on an annual basis if the bank required that you use that as collateral for your equipment for your company. And you did use that as collateral for your equipment, therefore there is no adjustment. However, we'd have to look into whether it was a specific requirement by the bank and the channels through which you made it. But assuming that it was a requirement, we did not make that adjustment. In terms of depreciation and amortization, that's an add back. And for accounting purposes, for tax purposes, we would have to calculate your CCA, which we did. We assumed a CCA rate of 6% for the building, 20% for the equipment, and 30% for the vehicles, which gave us a net deduction of $101,000. In terms of your income taxes payable, that is an accrual that has to be added back at $56,000, and only your actual income taxes are deducted. So with these adjustments, your end taxable income comes to $488,000. Your tax rate is 15%, assuming that you are eligible for the SBD credit. And that would net out your tax expenses to $73,000. Following that, we also noted that you were paying out some dividends to your trusts, to your family members. So we calculated your dividend refund that you're entitled to once you pay out those dividends. So this is following the integration principle. So your dividend refund is the lower of your ending RDPOH balance, which is $62,000, or essentially 1/3 of the dividends you actually paid. So 1/3 of 86 being $28,000, and that's the dividend refund that you would get back for this year. All right, so also we noted that you wanted to optimize essentially how much you could get back for your family, and that is a legitimate concern to have. So let's walk you through some of the options you have. To begin with, we noted that Stephen is actually providing some consulting services to your company, and A CRA essentially enables you to pay a reasonable dividend, and what is constituted as a reasonable dividend is anything you would pay to a non-arm's length individual, and that is a deductible expense for the company and, of course, taxable for Stephen. So we do note that Stephen does have a salary of 122 roughly right now, but this would essentially also increase his RSP contribution room, and that's another way you could take money out of the company. So you are allowed this. The money can be taken out and subsequently deducted from the corporation. Stephen can also contribute to the spousal RSP. Now, we notice that you're in an interesting situation. Currently, you're looking at selling your company. You are getting from the company, with your dividends and with your income as well, about $100,000. Once you sell the company, in the beginning couple of years, you're likely to be engaged in starting up a new business, perhaps incurring some losses. So here's something you can do. Today, Stephen can contribute to a spousal RSP, therefore make a contribution on your behalf, up to his contribution limit, which he has maximized this year, so for next year. And this would allow him a deduction with his income, but subsequently, if you don't do the withdrawal within 3 years, so you have a 3-year holding period, after 3 years, when you do withdraw the money, it will be taxed at your marginal rate. So this is a great opportunity, and we definitely suggest you avail yourself of it. And lastly, we'd like to talk about the universal child care benefit. So we noticed you have 3 little children, and I'm sure they're lovely and beautiful. The universal child care benefit that you do get from them, if you were to invest it, the attribution rules will not apply. So if you were to invest on behalf of your child for any other shares, the attribution income earned from those shares would be attributed back to you. The kiddie tax would kick in at the highest level, not optimal. But if you were to invest your universal child care benefit that you receive for the 3 children, the attribution rules will no longer apply. So we also suggest you avail yourself of that. We also noted that you took out a shareholder loan of $6,000. That's fantastic. We noticed that the last one you had prepaid within 1 year's time. Just a quick couple of notes on that. A shareholder loan must be repaid within 1 year, and essentially that's 2 balance sheet dates. If you don't repay it, it's an income inclusion in the year that it was made. And you'd also have to include, for the time that you're not, for the 2-year period, interest income. So essentially, we do recommend that the loan is repaid on time, and you also include your interest benefit.
Awesome.
Thank you.
Now, another program that we want to bring to your attention is the RESP. As you can see, your children right now are very young, and this is a great way to save money to pay for their education later on. Basically, the government will match your donation 20%. We'll give a grant to the RSP also to a limit of $500. So that means that if you do $200,000 contribution to the RESP, the government will add in a $500 per year, up until a limit of $7,200 per children. Also, you're allowed a clawback of 1 year, which just means you can essentially double this grant from the government every year by contributing $5,000 per children and getting a $1,000 grant from the government. So if we assume that your children will enter post-secondary education at 18 years old, and if you do maximize your contribution every year, we've noticed that you can max out the grant for Tom and Lily, so receive the whole $7,200 from the government, and you will be able to get a $6,000 grant for Charlotte. So this is something to think about. The other program that we want to talk about is the TFSA. So if you do have money left over after maybe contributing to RSP or to the RESP, the TFSA is a great opportunity to grow your assets and grow your money with tax-free, with no consequences for tax. So basically, your contributions are not deductible, but obviously your withdrawals are not taxed. That's always been taxed, and the growth that happens to the assets inside the program, the account, will not be taxed by the government. And if there is an over-contribution, then you will have a penalty of 1%. But we think this is not very likely, as since we assume you've never contributed to a TFSA. You and your husband both have $46,500 in the newsroom, which is pretty substantial. So finally, we want to also talk about your childcare expenses, as Miriam has talked a little bit before. Basically, you can deduct 2/3 of Paula's income. Basically, you should max out all the credits that you're allowed for your children, which will come down to a dollar limit of $5,000 for Charlotte and Tom, and a limit of $8,000 for Lily. The last point we want to talk about is the family trust. You didn't really give us any details about that, so we're gonna maybe need a little bit clearing up. So first of all, the dividends that are received by your children will be attributed back to you and your husband, which is maybe not the best. So we recommend that you take maybe more of a salary, not just $20,000 from your company, instead of receiving $86,000 in dividends, maybe put some of that towards a salary, because anyways it's going to get attributed back to you, so you're not really saving any taxes there. And the dividend does not contribute toward your RSP limit, and we think that the RSP is a great option. So by taking more of a salary, you increase your contribution limit per year for your RSP. The other point is that if you do invest in other companies, maybe do it by the trust. That would allow you, since your children are also beneficiaries of the trust, and also your husband Stephen, the capital gains that will be realized by these shares of future companies that you buy, the capital gain will be attributed to the trustees. So this means that your children and your husband will be able to use their lifetime capital gains deduction, which is very substantial, and you will be able to save a lot of taxes on that. So in conclusion, here's a little quick reminder of all the recommendations that we've made. When it comes to the sale of Aqua, we recommend that you sell the shares. After doing all the calculations with your corporate tax, we come down to a liability of about $73,222. Then when it comes to your personal taxes, we want you to consider the income splitting opportunities that do exist, the shareholder loan, and when to repay it. Finally, the TFSA and RSP are plans that you should probably consider. Max out your childcare expense deductions, and think about the tax planning within your trust. So thank you very much for your time, and we'll now open the floor to questions that you might have.
So you said that for future companies I could multiply the capital gains exemption. It'd be kind of cool if I could do it right now with the sale of Aqua. Is that possible, or is it out of the question? Or?
Well, one of the options that you do have is an 86 internal reorganization. And essentially that would involve you exchanging all your shares that you have, all the shares that she has, preferred shares, for another class of shares, and you have quite many that have been issued legally, and have that essentially exchange all of those shares that you have with the fair market value redemption take back the shares that the preferred shares with fixed redemption, and that would allow an internal reorganization where the trust would acquire these shares, and having sold that, the gain would then flow through the trust and to your beneficiaries.
Okay.
You said that the share, when you did the tax on the sale of the shares, you said that the shares didn't qualify for a qualified small business deduction. I think it missed the
70%.
If it's the 90% test?
90% test? Is there a way that you could, is there something that could be done to get you up to that 90 just prior to sale? Or?
Yeah, as you can see at the bottom of the slide, the recommendation says, in order to meet the 90% test, you should sell the accounts receivable and use the accumulated cash from selling the accounts receivable and the excess cash that you already have in your business to pay off your current liabilities, because you have a vast amount of liabilities in the business. And that way, there would be more assets available for that produce active business income.
Would it be beneficial to do that instead of using the deferral, because you sort of eliminated the tax with using the deferral of investing into a new company? Would it be better to try to purify the company and get my capital gains deductions now instead of using the deferral? Because the deferral, I'll still have some tax
At some point, right?
later on.
Yeah, we do suggest definitely to purify the business and use your lifetime capital gains deduction that, as you said, none of you have touched it already.
So at that point, I'm still only going to be able to take one, or may I take more?
Well, not necessarily. I believe we need to clarify some stuff. When we say deferral, we essentially mean that if you have your process of disposition that you've gathered, irrespective of whether that's done through immediate financing or whether that's done through incremental financing, that means that it's purchased through a loan. Those processes of dispositions, if they're reinvested in the shares of a qualified small business, you could defer that capital gain recognition. And that doesn't necessarily mean that you won't be utilizing the capital gain, you'll just be deferring it to a later date. Of course, if you'd rather use it right now, you're more than welcome to. So you do have that option. It's at your discretion.
Good. Thank you very much. Awesome. Do we need to do anything to the computer?
Nice presentation. Thank you.